price outlook on gold and silver. To moderate and present India Gold Outlook, requesting Mr. Chirag Sheth, Metal Focus, to come on stage. Ladies and gentlemen, can we please put our hands together for Mr. Chirag Sheth? And the panelists are Mr. Marcus Garvey, IIGC Standard, Mr. Cameron Alexander, Thomson Reuters, and Mr. Vijay Murthy, Hindustan Zinc Limited, India Silver Outlook.
Good evening, everybody. Probably the most exciting topic: where is the price of gold and silver actually going? And I've got a esteemed panel with me to take you through this. Probably the way we'll do is, Marcus and Cameron will talk about the international gold and silver market, and myself and Vijay will then follow on with the Indian scenario on gold and silver. I think if you look at 2018 has been a interesting start. After recovery in demand in 2017 for both gold and silver, we've actually seen a bit of slowdown coming into the market, both on the price front as well as on the demand side. Despite the fact that you've got trade war, you've got geopolitical tensions between US and Iran, gold and both silver prices have actually not reacted to that. I think physical investors are still very, very cautious, and probably what we'll try to do in the 45 minutes that is allotted to us, we'll try to run through all these factors and where do we see gold and silver, and then we'll take a poll on the forecast and your questions. So I'd like to invite Marcus to take you through the gold market. Actually, can we get Marcus' presentation, please?
The slides available? Sorry. Perfect, thank you. My name's Marcus Garvey, the commodities strategist at IIGC Standard Bank. I'm here obviously to present to you our outlook for the gold market, but if we get a result in the test match while I'm speaking, please feel free to interrupt me. Could we go to the first slide, please? Thanks very much. Now, I suppose I put these slides together a week or so ago before I came out here for the conference, and since then gold prices dropped low. We've made new lows around sort of 1204, but I don't think the dynamics have really changed. And actually, if you look at how gold has performed over the last sort of 6 months or so, really we've traded in line with foreign exchange, particularly initially, if you look at this chart on the left, in line with developed market foreign exchange. Gold really maintained its correlation to a trade-weighted basket of the US dollar. And then latterly, as we've come back, say, that chart showing in rupee terms, gold has caught down to the performance of emerging markets foreign exchange. Chirag mentioned, talk of a trade war. We have Donald Trump's Twitter account keeping many investors up at night. But if you look at gold, actually, although some investors have been disappointed with the performance of gold, I think gold's performance actually makes complete sense, really, over the past 6 months. You've got strong dollar, and you've had a very benign developed equity market. So there are headlines about trade wars and risk off, and various emerging markets have been very weak year to date. You have some particular ones like, say, Turkey or Argentina, but developed market equities are up on the year. Both if you look at, say, the S&P 500 or broader indexes such as MSCI World, and at the same time volatility, when you look at the VIX index in that chart on the left, has been relatively subdued. We had one spike during the sell-off in the first quarter, but otherwise volatility has been very calm. And so actually I think the underperformance of gold versus expectations is actually in keeping with how other financial assets have performed. Gold is not an outlier year to date. But if we're going to move away from what's happened so far and think, well, how can gold perform over the next 6 months, a year or so, and given the fact that the dollar has really been the biggest driver of things, I think we need to understand why the dollar has performed like it is and what do we expect from the dollar. Because particularly as that chart on the right shows, in the last few months when we've had dollar strength, that has not been driven by changes in the US interest rate market. In fact, the US yield curve, if you look at, say, the spread between a 2-year and 10-year treasury, has continued to flatten. and the dollar has rallied despite that, not because of it. And so I think in terms of our view on why the dollar has been so strong, and this comes back to the title of my presentation, it's all about expectations. So at the start of this year, many investors were long commodities, short the dollar, long emerging markets, short the dollar, and included in that long gold and short the dollar. But actually since then, the big growth dynamic globally has been that expectations have been disappointed. We came into this year with many investors expecting, with those positions that they had on, global growth to continue to accelerate in a synchronous fashion, and that hasn't happened. Actually, global growth has been relatively steady, as the PMIs suggest, but expectations have not been met. If you look at a surprise index, which measures expectations versus realized growth, it highlights that the growth has disappointed. And then if you look at which regions have caused that disappointment in growth, it's not the US. It's emerging markets and it's the Eurozone. And so investors who are positioned short the dollar have found actually that it's the US that's met or beaten expectations while the rest of the world has disappointed. And that, in my view, is why we've seen an outperformance of the dollar and an outperformance of US assets against emerging markets and commodities. But thinking now about the next 6 months or so, the market has repriced for this underperformance of other areas compared to the US already. Net length in gold futures is even lower actually than this chart shows if I were to update it for the latest data. And so the money flow back into the dollar has already occurred and markets have already repriced. The only exception to this, I think, or the only major exception to this at the moment is the longer dated part of the US interest rate curve. So we're fully priced on a September hike. The federal funds futures market implies over 90% probability of a hike. And for December, we're pricing pretty much 3/4. So the scope for a surprise there is limited. But if you wanted to create a scenario where gold would underperform longer term, the thing that could still move that is if longer dated interest rates in the US caught up with the Fed's dot plot. But we think that on the balance of risks, actually the interest rate market is right to be skeptical about the potential for longer run US interest rates to rise meaningfully. And therefore we think, given that the flow of money has already been away from gold, actually this is around the lows of the price for the gold market that we have right now. It's possible that for a short term we could dip below 1200, but actually we think this is a better time for medium-term investors to be allocating to gold given its defensive characteristics. And the reason I say that regarding the US is that this business cycle in the US, although at the headline level looks very healthy, has some concerning factors when you look under the hood. On one hand, this cycle has been heavily driven by consumer spending, and that consumer spending has been funded by consumers dis-saving. So the savings rate, actually this data has been revised up marginally in the last couple of weeks. Savings rate in the US is still concerningly low, and at the same time, despite growth being so good, there are signs now of credit stress. You look at auto loan delinquencies picking up and credit card delinquencies picking up. So I think it's very questionable whether the US consumer can withstand materially higher interest rates. So just to finish on my final slides, there is a scenario which could cause US consumers to be able to accelerate their purchases and to support a stronger dollar and to be bearish for gold. It's not zero probability, clearly. For that to happen, you'd need to see wage growth accelerate more meaningfully. But so far, that is still lacking, and that's both lacking on mean and median measures of wage growth. It's not a problem of measurement. It's clear across indicators. And the other thing you'd need to see is, this light blue line on the right-hand chart where effectively corporate investment has begun to pick up. that would need not only to stabilise around this better growth level of say 6-7%, but actually probably need to accelerate further. If you had those conditions, then you could argue that the US yield curve should start to steepen again and we could have a sustainably stronger dollar. But I think on balance of risks, actually, given where consumers now stand, given where interest rates are likely to be in 6 months or so time, actually the scope for then an additional 100 plus basis points of hikes is limited. The market is right to be skeptical about the dot plot, and that the gold market has already priced these scenarios, and if anything, as financial investors get short at these levels while physical demand is starting to show signs of reacting to lower prices and to pick up, it's actually a better time to be looking to add back into gold, and we think that gold is more likely on balance of risks here to move back towards 1300 or so over the next 6 months than it is to drop down meaningfully below 1200. And on that note, I'll finish and hand over.
Thanks, Marcus, and I'll start with some good news for you and some bad news for this audience that England just won the Test match. Thanks very much, and thank you for those that have stuck around. It's been a long day. I appreciate you hanging around to the last session. Right, we don't have much time. I think I've only got down to 10 minutes, so I'll be fairly brief. So I want to look today just really at the main fundamentals of silver and where we've come from and where we think we'll be going, and the major drivers that are going to push us there. So you can see from this chart, this is where we were at the end of last year, and mine production after 13 consecutive rises have fallen now for the last 2 years. We saw a 4% drop in mine production last year. We're expecting another drop in 2018. Scrap supply was relatively flat, so we saw a 2% drop in total supply. Jewellery and silverware were actually quite strong last year, and we saw a 4% growth combined. Growth in India was partly responsible for that. We saw quite healthy demand for silver jewellery in India, particularly for silverware in India, which rose by some 19% last year. The 2% drop in physical demand really comes about because of the weak investment demand. You can see here the very poor result last year in terms of coin and bar demand falling to 27% last year. So investors haven't really been interested in silver on the physical side at all. We saw last year, so we saw a physical deficit of around about 810 tonnes last year. It's about 3% of total demand, so which you could argue is more or less the balanced market when you can take into consideration the huge amounts of above ground stocks that are currently in the market. So here we have total net identifiable investment, which includes the bars and the coins, as I mentioned, and ETF demand as well. It's 40% lower last year. Investment was down last year on a lower physical investment, while ETF, although positive, was still lower than the 2016 number. So net identifiable investment reached $2.6 billion last year. That's down 60% from the high that we saw back in 2012 of almost $6.7 billion. And that partly explains the weaker interest in silver. There really has not been a great appetite for silver amongst investors. As mentioned, industrial demand is actually rising, and we saw some healthy gains last year, and we'll expect to see another year of healthy gains from the industrial sector. Most notably from the solar market, so PV, which jumped 19% last year to over 2,900 tonnes, and which accounts for about 17% of total industrial fabrication now. But China was the main contributor to the rise, accounting for more than half of new solar installations last year. Global capacity increased by some 24% year on year to 94 gigawatts. Now this chart sort of shows the silver powder production, and you can see the strong growth over the last couple of years. It's really just showing the transformation from silver bullion to silver powder. From there it's onto silver paste and then onto the actual solar panels themselves. And we're expecting to see a 15% growth this year in silver powder production, which should boost industrial demand even further. And that's going to be partly driven by growth from within the Indian market, and India is taking up the solar with renewed strength. We're seeing a lot of money flowing into to green energy, and also obviously growth within China and other emerging markets. We have seen in recent months China step in and actually reduce their rebate rate for solar, which may dent somewhat the growth that we were expecting at the start of this year. So we could, even though China's still going to grow this year, no doubt, but the growth rate might slow from what we thought at the start of the year. So despite a stronger jewellery and silverware and industrial market, total physical demand, as I mentioned, is down some 2% year on year. But if we exclude that investment portion, which is that mustard colour at the top there, those sectors actually increased by 4% year on year. So what it does is actually points to a bit of a dichotomy in the market. We have a sort of very weak physical investment demand, but strong physical and industrial demand last year. And we're seeing the very same situation in 2018, where the investment side is very weak, but the industrial side and jewellery is actually quite strong. So it's quite an unusual situation. I'm just briefly touching on the supply side and indeed mine production. And as mentioned, we saw 13 consecutive years of increases in mine supply. In 2016 and 17, we saw a decline in mine production, and we're expecting to see further falls in the future coming years. So in the left side there, we can see that on a breakdown, the Americas dominate in terms of supply, and almost 60% of the total there. And also you can see that on the right-hand side, we've seen after 2 years now, we're actually moving into a declining trend for mine production, and we expect to see drops in mine production now for the next couple of years. It's probably important to recognise that the bulk of silver production doesn't come from primary silver mines. In fact, where silver is mined selectively, but as a byproduct of obviously gold mining and all base metals. So it's movements in price of those areas that can obviously influence the supply of silver. So we look at this chart, it's basically just showing that primary silver sitting there at around 28% of total production. Gold, the market share of gold was up last year, as was the lead zinc market share. And on the right side, it's sort of just showing here that the silver production from gold miners has been the standout, and that's been increasing considerably over the last few years. One of the major hurdles for silver to overcome, at least from a fundamental point of view, has been a significant level of above ground stocks, metals sitting in the vaults. Above ground stocks continue to rise in 2017, albeit less pronounced from the year before. The biggest rise was registered in Europe. We saw a 20% growth there, and also in North America, which rose by some 10%. Asian market, which still dominates at almost half of the vaulted stocks, fell by some 4%. So stocks last year stood at 86,500 tonnes, and these inventories could cover 33 months of cover, which is a 22-year high. That's another reason why there's a lot of pressure on the silver price. So ETFs or ETPs have also seen a rapid rise over the last few years, and you could argue that the rise in supply over that period has been absorbed by the increase in ETPs. Mine supply rose by some 295 ounces 200 million ounces between 2000 and 2017, while ETPs rose some 670 million ounces over the same period. The ETPs have been stagnating though over the last year or so, and that's been reflected also in the weak sentiment on the physical side. Year to date, we have seen outflows from silver ETFs of some 265 tonnes, with total holdings down only just 1% though year on year. In the silver ETFs, the hands tend to be a bit more stickier. They tend to be a bit less reluctant to sell, unlike the gold side, which is far more liquid. But as I said, at the moment, investors aren't really that interested are interested in looking elsewhere aside from the precious metals markets. So looking at the gold-silver ratio, and this is an old chart that a lot of investors like to look at. Silver is still cheap compared to gold, or gold is expensive compared to silver. Tend to take your pick. Every time we hit that sort of 80 level mark, the ratio reverts back to the mean of around 55 over the last sort of 50-year period. So based on those figures, there could be potential for silver to accelerate compared to gold. And we are expecting silver prices to move slightly higher in the second half of this year, and this ratio to ease back to the 76 to 77 level. I think we're currently sitting around the 79 level currently. But in reality, though, the fundamentals mean very little when it comes to the silver price. I think at best it really just provides a bit of support to the price. Of more influence is obviously the movements in the gold price, and at times the base metal sector as well. Silver can oscillate between being considered a precious metal and sometimes it's considered an industrial metal. So it really depends on how the market is viewing silver on its day. And silver obviously has a very strong correlation with gold, and you can see here over the longer long-term trading pattern. But you can see over the last year or so, we've seen a bit of a breakaway as silver's been considered more an industrial metal than its precious metal cousin. The base metals performance recently has been a factor, and the casualty of, and has been a casualty of the Trump sort of import tariff war. So silver has been viewed as more of an industrial metal over the last 6 months or so, and that's been dragging the price lower, or at least sort of preventing it from following gold if gold moves higher. So what will the drivers be for silver? And I don't need to, I think Mark has covered it fairly well in terms of where he thinks gold prices, why gold prices might move higher or lower. And I think our views are quite similar. I think the strength in the US dollar over the last 12 months or so has been a considerable factor in the weakness that we're seeing in current precious metals pricing. And even though I can't see any immediate reason why the US dollar will start to weaken, which would generate higher prices, I think a couple of points that Mark has mentioned in terms of the lack of consumer spending, and but the lack of wages growth, or the fact that wages aren't growing at all, is enough maybe to put in a little bit of uncertainty in the market. I think the geopolitical risk may be enough to drive prices slightly higher if that was to continue. Something like the untidy Brexit could also be an issue. But these things are all speculative, and at the moment there's probably not enough to drive precious metals higher. I think more so, we also don't think gold prices are going to drop much below current levels, and we think we're very close to the lows at the present moment. Even though if gold prices were to move slightly higher, and we're back to sort of the 1230, 1250 level, I'm not sure that silver prices would move much higher if we continue to see this current environment of rhetoric coming out of the United States and China. So if we see further escalation of trade war talks, I think base metals may suffer more, particularly out of China and emerging markets, and that will probably drive silver prices slightly lower. So we're looking, I guess the other issue which people always mention to us is in the equity market. We've seen such strong growth in equities over the last couple of years now, and that's certainly pulling assets away from other asset classes, and particularly precious metals. So if we were to see some kind of correction in the equity market, we've seen that in recent days in the industrial, or in the Facebook example. That could also generate a slight increase in the precious metals prices, but they're all what ifs, and it's not really our base case scenario. So we are looking for prices to move slightly higher towards the end of this year and over the next 2 or 3 years, but prices will be fairly contained, and we see silver trading at around $18.90 within sort of by 2020. Over the next couple of years, though, it's going to be a very, very gradual increase. And finally, you can just see our sort of 3-year forecast for silver and our averages there. Thank you very much. I think I'll pass it on. Thank you.
Yep, thank you very much. I'll run through the Indian gold market. I think what is happening in India is there's a lot of structural change which is happening in the Indian gold market, and this structural change is actually happening not at the supply end as well as at the consumption end. And I think it would be interesting to see how Indian market develops over the next, especially the gold market develops over the next 2 to 3 years time. So if you look at Indian bullion imports, and if you actually remove 2016 out, despite all the regulatory changes, governments clamped down on unaccounted money, PAN card, I think if you look at Indian market has been fairly resilient. But however, this chart doesn't tell you the real story. I think the next chart really tells you the story, what is happening. What is happening in the Indian market is we are moving out from just a pure refined gold importer towards Dore importer. And so obviously what is happening in India is if you look at the share of Dore, from less than 10% in 2012 to today, the Dore imports have increased by more, the share of Dore is now at 50%. However, if you actually break down this Dore imports, out of, whatever you call 28 to 30 refineries that import Dore, 4 or 5 refineries have got the predominant market share, which means that large part of refineries who are importing Dore are still running on very, very low capacity. And that is happening because of the fact that if you look at global refining capacity vis-a-vis Dore production, global refining capacity is 2.5% of doré production in the world. So it is only the world-class Indian refineries who are able to adhere to standards would eventually be able to get doré. And I think that is the story of bullion imports in India going forward. If you move on to consumption side, and there is a much more interesting story. Again, if you remove 2016 out, Indian consumption has been fairly resilient. Now it is very, very important to break Indian consumption into how investment demand has behaved and how jewelry demand has behaved. And if you look at investment demand post 2013, when the entire regulatory scenario changed, be it regulatory scenario, the introduction of compulsory PAN card, restrictions on high value cash transaction, governments clamped down on unaccounted money, demonetization, or even the underperformance of gold prices have actually moved investor away from gold. And I think some of you all, I'm sure a lot of you all did get an opportunity to read our India Monthly, which we released on 1st of August, where we mentioned how the entire investment demand is going through a structural change. I think what people miss out is, often people take Indian gold demand for granted. And I think here we are actually seeing what is happening is that today gold is facing much more competition from foreign vacations, from two-wheelers, from four-wheelers, from people. There is an increasing consumerism in India. And I think Professor Rathi yesterday made an interesting point, is that gold is no longer an impulsive purchase. Gold is, I would buy gold if I want gold, especially on the financial side, especially on the investment side. And that is true today. You look at the amount of money that is going through the mutual fund route into the Indian stock markets. Somewhere there is a shift out of gold towards equities and towards other financial products. And that is why we are seeing investment demand dropping sharply. Having said that, if you look at the, the two bars over here, one is the blue bar is the gold jewelry fabrication in India, and the orange bar is the gold jewelry consumption. I think gold jewelry consumption has been much more resilient compared to gold investment demand. And that probably shows the stickiness of our wedding demand in India, the stickiness of gold jewelry ingrained still in Indian culture. However, what we are seeing is couple of things. What we are seeing is that the average weight of gold jewelry bought compared to 6-7 years ago going down. However, the resilience is because of the rising income, so people still consume a lot of gold. What we've also seen interestingly is that over the last 5 or 6 years, fabrication of gold jewelry in India has outperformed consumption of gold jewelry in India. And that is largely due to the growth of branded players in India. And the next chart would actually show you what is happening in India is that there is a growth of branded players in India. So from 2010, when branded players or chain stores commanded a less than 10% market share, these chain stores today have got more than 30% market share. And we believe that probably by in next 5 years, this market share would be anywhere between 40 to 42%. Now, what is really happening, and that's where the whole structural change is happening, is that where more and more people are now moving towards branded players as they want better designs, they want better purity, better quality, and I think more number of options available, and that is what the branded players are actually catering into. So in summation, what I would like to say is that Indian market is undergoing a structural change. There is an opportunity for refineries to take further a larger market share of the market. However, there is a difficult course in terms of limited availability of doré. Whereas on the consumption side, we believe that the investment demand would continue to remain tepid, whereas the jewelry demand would continue to see growth as urbanization of rural India happens. And this is something we've seen. If you actually go to Mumbai and speak with a jeweler who's got store in Mumbai and probably store outskirts of Mumbai, he would tell you that his store outskirts of Mumbai has done much better business in store in Mumbai. And this is story across India. We've seen in states like MP, Rajasthan, Maharashtra, Gujarat, the rural centers have done much better business than the urban centers, and that probably talks about how business is shifting. I think that's it from my side. I would like Vijay to give a bit perspective on the silver market.
I think we'll have the panel discussion as well on some of the points, but mainly to cover the India consumption side and our perspectives as a primary producer of the only primary producer of silver in India from Hindustan Zinc side. I'd like to touch upon a few points, and I do share a lot of views, very similar views. It's not by design, but but we tend to agree on some of the points. The Indian domestic market, if you see, has been in a bit of a flux, and I would tend to share Chirag's comments that we have undergone a substantial structural shift in the last couple of years, be it from starting from excise duty introduction in March 16 all the way to demonetization and then introduction of GST. Obviously, the industry has gone through a bit of pain. But what is more important, what we are seeing in the as primary producers, a brief overview would be that Hindustan Zinc is the only primary producer of silver in India from a mining route, and our intentions have been from a make in India and also from an import substitution perspective. Why can't we produce more silver in India, whilst we have been a primary zinc and lead producer? So we have been successfully enough, through our mining operations and with a clear focus on silver as not as a byproduct but also as a very important main product. We have successfully increased our production from 350 to 450, and now last year we ended up with a number of 555 tons of silver production. So we still probably are about 15-16% of the Indian market. But the shifts we are seeing in the consumption trends are that we are as of now seeing much stronger demand in the industrial segment as compared to what it was 2 years ago. We are seeing that the electrical contacts and the applications in the industrial segment has improved. The traditional jewelry is not necessarily the pile or the chain which traditional feel has been that it sells in rural India. We do have people in urban India today wearing fashionable silver jewelry. I've seen a lot of my male friends wearing armlets or very fashionable men's accessories, cufflinks made out of silver, etc. So there's a demographic pattern shift as well which is happening in terms of consumption. So from an investment perspective, I think today's prices are pretty subdued, and the 38,500, 39,000 rupees per kilo price what we are seeing today, and the continuous fall of the silver price in dollars per ounce to 15.5. And personally we believe that the way the situation is, that this should start triggering investment demand in India as well, because had the rupee been at 64.5, then we would have seen a price of probably 34,000 tons. And in the last many years, we have seen the lowest price at 32, which created a record import in the year 2015, if I am not wrong. So Indians typically have a lot of affinity for gold and silver, but I think the ratios of the gold silver ratio, which is currently very high at close to 80, I think substantially undervalues silver. And the supply side reductions which are happening from the pure primary mining side or from the copper concentrate, zinc mining route, etc. There is input cost pressures there as well. So we could potentially see some more outages from the Western world. So overall, we are seeing that the Indian demand remains robust, but how this demographic shift between gold and silver will happen and play out over the couple of years is something to wait and watch. But we as a company been very focused on developing the Indian silver market and continue to produce more and cater to the requirement. But still, it's a large 4,500 ton market. Our increase in production will only be substituting a small portion of it. But our bigger objective is to grow the industrial consumption. And the way the situation is currently on the push for solar, we personally believe that there is a very huge opportunity with a target of 20 gigawatt of renewables, especially on the solar side. I think solar is the space to look out for, which could drive the industrial demand in India substantially.
Thank you. Marcus, I had you pointed out about the yield curve, and usually the flattening of the yield curve is an indication of recession, upcoming recession. And there is also the trade war, as Cameron pointed out, the rhetoric out of US and China. Having said that, I think these are kind of perfect storm scenarios which should have helped gold prices higher. How do you react to this? When there is this negative, yield curve, flattening of yield curve, trade war scenario, US-Iran tensions, but gold has not really reacted. What is happening, and are we missing out something over here, or does it require a much larger factor for gold to reverse?
It's a good question. I think there's a few different things at play there. One point that I made in my presentation with the slides that I think, and is also relevant to what you were saying about the Indian market with alternative investment opportunities. Developed market equities have not priced a trade war as being an issue. I mean, Cameron mentioned obviously we've had a little bit of a sell-off in tech stocks recently, which is different. But overall, developed market equities have been very robust. And while that's the case, given that a trade war is being seen as an additional input to dollar strength, I think it makes sense when you look at cross-asset performance why gold has underperformed. I do think, though, if you now had a material sell-off in developed market equities at some point, then that could change the dynamics quite quickly. And although gold, because in those circumstances you'd still probably have a reasonably strong dollar, gold may not rally too aggressively, but it would, I think, outperform significantly on a relative basis. I think one point I'd make there on equities performance is quite interesting. If you look at a lot of commodities which have, something Cameron mentioned in terms of industrial commodities like the base metals that have been very weak, and also say like the PGMs have been very weak recently, and they've effectively priced that a trade war will be bad for their macroeconomic demand. However, equities have generally discounted the trade war's impact on the microeconomic aspects of their business. But interestingly, if you look at the auto companies' results over the past 2 weeks, and General Motors suffered a decent sell-off, talking about higher input costs in the US from tariffs. Fiat Chrysler, I mean, there's obviously the sad news about their chief executive probably added to the move in their shares, but they also sold off more than 10%, and were highlighting the fact that tariff changes in China are causing their margin compression. So I think one of the weird things in markets at the moment is that a lot of equities are discounting the microeconomic impacts on their business of a trade war, while the commodities are pricing in that it would almost certainly be bad for demand. And that divergence, I don't think, can sustain. And either you come to a scenario where the macroeconomic impact is not too bad, commodities reprice higher, and the dollar is a bit weaker, which would also help gold and silver, or you need a catch down in some of the equity markets as they reflect the fact that a trade war will have negative impacts, in which case, because you'd have dollar strength, gold probably wouldn't rally significantly, but I think it would outperform substantially on a relative basis to other asset classes.
Right. Cameron, you track a lot of physical markets, and I think what is interesting is, despite the, correction that we've seen in the international gold prices, physical demand has actually not reacted. You look at India, to some extent, China, the Middle East. I think apart from Iran, most of the market have not really reacted to the, drop in gold prices. How do you put this into perspective?
You're talking about gold. Yeah. I think that just at the moment there's been such a choice for investment dollars. I think that's part of the problem is when you have streams that are giving you a very strong return, putting gold, which is really a non-yielding asset, to work is not really going to pay off, give you a dividend. So people are looking, why would you put money into gold or silver in a declining market when you can put your money into equities or other asset classes to deliver yield? I think over the last year or two, that's been a big driver, particularly in places where gold plays a very important role in investment, in, say, Southeast Asian countries. They've seen prices of precious metals decline over some time now. So to go have to put their funds from agriculture or from other gains into investment, which may be worth less in 12 months' time, when they can see that other asset classes are delivering a higher yield, it's always going to be a trouble for those metals. So we are seeing younger generations in particular also look to other options as opposed to buying into gold. And places like, as you said, Thailand and those kind of markets, there is reaction to when prices become lower. We are seeing immediate reaction to people buying on the lows, but they're not buying to the same degree that they may have been doing several years ago. So I think it's more about competition from other asset classes, particularly when in a declining market.
But would you also say that there is a depreciation of emerging market currencies, and we've seen emerging market currencies depreciating anywhere between 6% to 15-20%. So that obviously makes domestic gold prices much higher. How much has that played part in?
Massively. I mean they're obviously buying and trading within their own currency in terms of the local gold price. So that makes a big difference. So we saw last year in Thailand, even though the gold price in dollar terms came down significantly, in Thai baht prices is actually at a multi-year high. So that encourages a great deal of selling rather than buying. So local currency movements have a huge impact on local consumption. And even though gold prices in US dollar terms is lower, it doesn't always translate to higher demand in those countries.
Vijay, actually, there was a lot of discussion on, Make in India. And one of the success stories of actually mining Make in India is, your silver production in that sense and how it has, moved up over the last 3 or 4 years. What is the reason? Are you targeting some silver rich deposit? Because traditionally Hindustan Zinc is a zinc mining, company, and a zinc mining company producing 500 tons of silver is actually, phenomenal feat. So in that sense, what would you attribute this to? Have you found out some silver-rich deposit and that is yielding higher realization, or are you now looking at a concentrated strategy towards silver?
Uh, Chirag, I think the answer is pretty straightforward. Whilst most of the zinc-led mining companies do produce silver, the historical belief has been more of an attitude towards it as a byproduct.
Absolutely.
A couple of years ago, probably we and our team realized that it's no longer sensible to call it a byproduct. Let's look at it as a main product. But more importantly, what has happened, Hindustan Zinc within the state of Rajasthan has a bit of a complex operation between 5 mines, 4 smelters, and we have developed new mining operations. So the shift which has happened in the nature of the ore body has actually benefited us in terms of producing more lead and more silver. So we have our expansions which have happened historically. The main biggest zinc producing location of ours was called Rampura Agucha. So the Rampura Agucha open cast saw its fabulous end of life in March 2018. But we have also ramped up to maintain our production schedule. We have ramped up our other mines called Sindesar Kurd and Rajpura Dariba. Fortunately for us, the Rajpura Dariba and the SK Sindesar Kurd ore bodies are pretty rich in lead and silver. So we have also, as a conscious strategy, worked upon how do we increase recoveries as well, apart from targeting only silver rich sections. Obviously it's but natural that a miner will like to track some silver rich lenses, etc. But a lot of recovery improvement projects have been taken up at the company at the smelting level. So the silver in zinc, which was going down as a waste previously, we have been seriously working upon it with technical solutions to recover that silver, whilst from the lead stream anyway the silver is available. So it's been a conscious strategy of, yes, chasing some silver in the ore body and also improving recoveries. And as a very stated clear objective and target of the company, we do intend to hit 1,000 ton silver as a target in a couple of years time. It could be in 3 years, it could be in 5 years, we don't know. But if previous history is anything to go by, we have increased 100 tons production every year from 350 to 450 to 550. Hopefully 650 is a target, we don't know, but we are pretty confident 600 plus for this year.
This is a question to Cameron and Vijay, both of you all. Cameron, you pointed out about silver powder, the growth of solar. The Indian government is now looking at imposing a safeguard duty 25% on imported solar paste, from China, Taiwan, and Malaysia. How do you think this changing actually dynamics? Because from what my little understanding on the technology is, it would take at least 18 to 24 months for that technology to be in India. So how does that change the entire dynamics? For global production, and Vijay, if you could just take the Indian scenario.
Yeah, the actual technology to produce powder of the quality that's required for solar is actually very high. Japanese have dominated over the last decade or so, and we're only just seeing China able to produce silver powder at that kind of quality. Now they had to do that. They basically borrowed or gone to the US and bought all the technology from the US and brought in all their specialists to be able to do that. So China will start to now produce their own silver powder at the same quality that the Japanese can do. But to do the same thing in India is going to take some time. I think generally most places can't produce powder of that quality, and to invest, it's going to take a lot of money, a lot of resources to get to that level. And to think it's going to happen overnight is probably a little bit optimistic. I think it's more likely to be a longer plan before India can get to that same stage.
Vijay, would you like to add something on this?
I think this news came in recently, I think just a couple of days ago, and I was actually pretty taken aback on this. But I think if you look at the stance of the government, which has been very seriously to promote Make in India, and if you see finally Apple also buckled under pressure and said, okay, we're going to put up a Foxconn on behalf of Apple setting up a mobile manufacturing facility in Bangalore. So I think it's been a bit of, I wouldn't call it arm twisting, but a bit of smart negotiations to make sure that the real Make in India thing takes off. So it might take 2 years, it might take 2.5 years to sort of get the real tech behind producing the right quality of the solar paste, etc. But I think it's a bit of a short-term pain for long-term gain, so that we have a very lofty target about 20 gigawatt of solar power in the years to come. So, but I think maybe government might have to rationalize some duty in the intervening, but I think Make in India is the real target, and we should pursue that.
Marcus, one last question before we, go in for polls and the question. Uh, you know, Fed has been very aggressive in increasing the interest rate. They've already had, we're now looking at 2 hikes, as you mentioned. Uh, what is the Fed neutral rate where, then Fed would pause and probably move from a hawkish stance to a more dovish stance? Usually we've heard 2.5%, 3% is what it is. What according to you is the rate at which Fed would pause?
Yeah, it's a difficult question. So the FOMC themselves are still saying that the neutral longer run rate will be just below 3%, but actually implying in their own forecasts that they will overshoot that and probably get up to kind of the best part of 3.5%. I think it's still credible that a longer run neutral rate could be 3%. Whether we actually achieve that in this hiking cycle, though, I think is highly questionable because of the fact, as discussed, that wage growth has been relatively muted and that consumer stress or consumer credit stress is already showing up. So I think for this cycle, kind of mid to high twos is more likely to be the peak than, say, the mid threes. But if you were to say, take over time, could we at some point go back to that kind of 3% equilibrium level? Yeah, I think that's still quite plausible. Just when you think about if inflation is at 2% and then you're getting your kind of your real rate only a percent or so above that, I think that's plausible on a medium term outlook.
Vijay, would you like to take this question, which is saying, what is the production cost of silver in India?
When I read it for the first time when it flashed in, I started smiling. That's something which many customers of ours, many shareholders of ours ask as well. Incidentally, we are a polymetallic ore body, so it's absolutely getting into hair splitting if you try to find out, what we call TMC, that is the total metal content at ore level all the way up till the refinery. So it's too much of effort for too little gain to understand. So we are happy with a good price, but unfortunately we have not taken too much of pains to really go and identify the cost of production, because it comes naturally along with the lead and zinc, which predominantly absorb the cost of production.
Cameron, would you like to add, probably for global, primary silver mine, what is the cost of production, maybe?
Yeah, I mean, it's also worth considering that primary silver is only 35% of the market,
Yeah.
so it does get absorbed in the base metal side. It's less than normally about less than $9.
Right,
Cost.
right. So this is an interesting question, and Marcus, if you could just, probably answer this. As trade wars are happening, many countries are rushing to devalue their currencies to compensate the tariff imposed. Would this actually lead to probably a currency crisis of sorts? Too much of devaluation of currency, makes it difficult.
I think a global currency crisis is very unlikely. If you look at how devaluations have occurred in the last few months, you have some pretty extreme ones in, say, Argentina is the single biggest case. You have, say, Turkey. In terms of major currencies, the only one that's really devalued rapidly recently is China. And actually, if you look at the renminbi on a cross-currency basis, it was appreciating through much of the first quarter and even into the early part of the second quarter, because it was appreciating, say, against the euro, against the yen. It's then caught back to more like flat, only small down, actually, on a cross-currency basis now. But then it has depreciated meaningfully against the dollar. I think, though, that for the Chinese authorities to allow a really sharp depreciation from here in the renminbi is unlikely. Because if you go back to when they did do a devaluation sort of 2+ years ago, what that triggered was a degree of capital flight from the country as domestic investors and corporates were concerned that the currency would devalue rapidly from there. And as a result, the central bank was forced to crack down on channels through which capital could leave the country, and also to spend a meaningful amount of their central bank reserves in then supporting the currency to prevent it from devaluing aggressively further. So having sorted that problem out 2 years ago, and they don't want to reopen that issue, I think it's unlikely that they will allow a sort of a sudden 10% devaluation, for example. So I think it's much more likely that they manage a slightly weaker currency against the dollar as a kind of quid pro quo.
So you don't believe you're likely to get into a currency war kind of situation where one country is trying to...
I think at the moment it's unlikely. And actually, if you think about it also, the US may be the only major central bank that is gone through a sort of sustained hiking cycle, but the ECB is about to start tapering and will most likely within the next 18 months hike back from what are negative rates, obviously on a deposit basis. It's still in extreme territory. I don't think there's much room for them to go more dovish. The Bank of Japan has made its first move really in the last week to start to move a little bit further away from its most extreme policies. So actually, really, I think if you're going to say, is there a currency war, it would come down to US versus China. I don't think the Chinese will go for a disorderly or dramatic devaluation. And the other thing I think you need to bear in mind with the dollar strength is that from a trade perspective, if the US actually genuinely wants to bring down their trade deficit, then a weaker dollar is, if not sufficient, at least a necessary condition. So you could get, I mean, if you want something that's more constructive for the gold price, then it would be if the US authorities start to talk down the dollar, because that is currently running counter to their stated policy goals. So I think a global trade or currency crisis is unlikely. You probably have a little bit more downside from China as a quid pro quo in trade negotiations. But actually, the thing that could come in that would help gold would be if the US starts to more meaningfully talk down the dollar itself.
Can we just have a quick comment from all of you all on what are your price forecast, for 2018 and probably 2019? We did a poll, as well. Can we have the results of the poll? So yeah, we did a poll on where would a gold price be at the end of 2018, and it is interesting that majority of the population feels that it would be about 1350. Would you all be in the same boat?
We're a bit lower. I think we have an average of the year about just over $1,300 for the full year. So we're looking for a slight uptick in the second half of the year. And I'd say, was it end of the year price?
Yep.
Probably 1340.
Yep.
Price.
Yeah, we are at about 1380 is 1370, 1380 is our forecast. Marcus, what would be?
You can rely on people at a gold conference to be bullish on the gold price. Little bit more conservative, I suppose, but I think kind of up into the mid 1300s, sort of like 1330, 1340 area is more my base case. So yeah, I mean, my forecast for the average has been a bit above 1300.
So I think most of the population does believe that market would improve from here on. Cameron, would you say this would be driven by physical demand, or is it likely to be more financial?
No, it's certainly macro side.
It's more of the macro side in that sense. Can we have the silver one, please? Vijay, actually. Yeah, that is. I think it was. Is that it? Are there more people? Okay, it's okay. But still, Vijay, what is Hindustan Zinc's? I'm sure you would have a house forecast for silver. I'm sure 17 and above would make you very happy.
I can only wish all those people who voted for 17.5 plus that what they say comes right. But just to share with you, as a company, we don't really make forward forecasts, because as a philosophy, most of the mining companies are price takers, and
Right.
we don't hedge either. So, but being in the industry and talking to the people around and looking at Indian consumption, maybe my take would be 1775, closer to 18 kind of a number for later part of this year. Looks good, but currently 1550 is very low. So if you ask me, pretty bullish on price and consumption both.
Cameron, Marcus, what would be your views on silver?
I think it's hard to be quite as optimistic as the audience. I think could it get back up to say 17 or so, get into that 1650, 1750 range bucket. I think that's more plausible. It was highlighted in the presentations that the ratio has really blown out, and I think there's a good chance that comes back in a bit. But given if you do believe that actually the things will be driven in terms of setting that price level by the financial markets, it needs to be kept in mind that although silver did earlier in the year for a period have very short financial positioning, now it's a bit short, but it's not extreme. Whereas actually the gold market is the one that has seen the biggest move down in financial positioning, and so I think it'll be hard.
So would it be more influenced by base metals, or would it be influenced because last year when base metals moved, or silver didn't do anything, gold moved, or silver didn't do anything. what do you think? What is going to be the biggest influencer on silver? Is it going to be the gold, or is it going to be base metals?
I think it's going to be the dollar. I mean, I suppose silver. One of the problems is at the moment, while it's somewhat unloved from an investor's perspective, if base metals are doing badly, people will probably choose not to invest in silver and blame it on that. If gold's not doing very well, they'll choose not to invest in silver and blame it on that. So it depends on kind of which side of bed someone's got out of in the morning. I think for the second half of this year, though, I'm not really that negative on base metals for separate reasons that beyond the scope of this conference. But so I think though, just from a financial markets perspective, there is good scope for gold positioning to clean up and help be a bit of a tailwind to the gold price. There is slightly less of that for silver. So although you could see the silver-gold ratio, given it's reached kind of around the range wides, coming in a bit, it's hard to see why in the next, say, 2 or 3 months it will come in materially. And that's why I think the silver price should follow gold if we believe that gold can appreciate a bit. But I don't think it can really make that kind of big jump up to something like an 18 number. I think that's probably a bit over optimistic.
Do we have time for question? Have we run? I think we've run out of the time. Yeah, I think that's an interesting one. Can you comment on average cost of mining gold, silver against the spot? Are they selling below or above? Cameron, would you like to take this?
Yeah, as been,
Maybe on the gold perspective,
yeah, I mean, the cost of mining is making some very good money still.
Yeah.
I mean, as I said, for silver, it's less than $9 against the current spot price of whatever it is, $15 or whatever. So they're making some very good margins on that side. And on the for gold, what's the cost? I think last year was about $980.
Yeah, 975 is where we are. Yeah.
So again, against the spot rate of today, they're still making some fairly good margin.
No, I think even on all-in sustaining basis, I think it is still a profitable business given where the prices are, and given our bullish expectation on gold and silver prices, I think it is the margins would actually increase. Thank you very much, and thank you for my panelist. Thank you.
Well, thank you very much, everyone. Now, I would request Mr. Chirag Seth to present the mementos to our panelists. Mr. Marcus Garvey. Ladies and gentlemen, can we please put our hands together for Mr. Marcus Garvey? Mr. Cameron Alexander. And Mr. Vijay Murthy. And now I would request Mr. Avardhani, ICBC Standard, to come on stage to present the memento to Mr. Chirag Seth.